Let's unpack sanctions and their effects step by step. Sanctions are powerful penalties countries impose to influence another nation's behavior, a critical foreign policy tool that sits between diplomacy and war. These measures can be sweeping, like broad trade restrictions blocking key goods, or financial, cutting off a country's access to the global banking system. This can cripple an economy. On a more personal level, sanctions include asset freezes, locking up the foreign-held wealth of powerful officials, and travel bans preventing them from entering sanctioning countries. The goal is to apply significant pressure without military force. The United States, for example, frequently wields this power against nations like Russia for its actions in Ukraine, or Iran and North Korea to curb their nuclear ambitions. Sanctioning the United States is a bold and rare move. As the world's largest economy with the dollar as the global reserve currency, any sanctions could easily backfire on the imposing nation. However, this doesn't mean the US is immune. In response to American pressure, global powers like Russia and China have retaliated with carefully targeted restrictions, often called counter-sanctions. These measures are strategic. For example, China has restricted US defense contractors involved in arms sales to Taiwan. Meanwhile, Russia famously implemented a sweeping ban on American food imports, a direct retaliation for sanctions imposed over its actions in Ukraine. When the US imposes sanctions, it's an economic event that ripples through our interconnected global economy and back into American markets. The initial shockwave often hits the stock market as investors react to the new geopolitical landscape and the uncertainty it brings. US firms doing business in sanctioned countries face a direct hit. They can lose revenue or be forced to halt operations, causing their stock prices to drop as investors sell off. Critical supply chains can also be severed, forcing companies to find costly alternatives. When sanctions limit resources like oil from a major exporter, global prices spike. This isn't just about paying more at the pump. Higher energy costs drive up manufacturing and transportation expenses, leading to broader inflation for consumers. This instability creates market volatility with clear winners and losers. While sectors like international banking may suffer, others gain. Geopolitical tensions often boost defense contractor stocks, and domestic energy producers can thrive by filling the supply gap. In summary, sanctions are an economic pressure tool. The US is largely protected by its economic weight, but sanctions still create stock market winners, losers, and volatility, especially in energy and defense.